Hello, welcome back. I wanted to jump into a continuation of our conversation on ratios and metrics, and specifically focus on efficiency ratios. Best way to start this off is to offer that efficiency ratios are actually going to bring together our income statement and our balance sheet. So just that's a calculation point, but also a comment about like how and why we use these. What we're trying to do here is now start to weave together the information on our financial statements. And so if you just looked at the balance sheet or the income statement, we really wouldn't learn much about efficiency. But when we bring them together, and specifically bring them together with a bunch of efficiency related ratios, we can better understand how efficiently is the company in general using its assets to generate things. And generally speaking, that thing we're talking about is the most important thing for a company to generate revenue. So on the balance sheet, we can start on the balance sheet. I'm sorry, that's where I'm going to start, but I'm actually going to apply these to the income statement as well. We have what are called turnovers. Turnovers represent how many times during the year that item is used to generate revenue. So total assets, our total asset, all of these can be followed with the word turnover. Total asset turnover. How we take revenue, we divide it by our total assets, or more commonly, our average total assets. So our denominator is an average of the item, all the ones I'm going to talk here, and the numerator is going to be revenue. So what is that basically showing? If we have an amount on the bottom and the denominator on average, and then we divide that into revenue, we're determining how many times we're able to generate revenue from that base of assets. So take our total assets in the denominator, average total assets, divide that into revenue. If it's 12, that means we can use those assets on average to generate, each dollar of assets generates $12 of revenue, or the dollar of asset is used 12 times to generate revenue during each year or each period. So we want this like higher turnover in this regard would say that we're more efficient. I want to be clear, that's not necessarily better, but because we want to look at other things as well. Just as a quick, for example, you could sell more of something, but do so at a lower profitability point. It may not necessarily be creating more value, but on its own, having a greater turnover indicates greater efficiency. Generally speaking, that's probably a good thing, but I don't want to make a blanket statement. Total asset turnover, revenue divided by average total assets. How well we use all of our assets to generate revenue. Well, there's a reasonable limitation to that, which is that not all of our assets are actually, we don't have them all specifically to generate revenue. As one example, a company could have what are called like marketable securities or other kinds of financial assets. And if they're not a bank, those aren't really revenue generating. It might be where they're storing excess cash. It might be where they're getting a little bit of a return, but it's not really driving revenue. It might be driving income or something else, but not really revenue. Unlike something like inventory or property, plant, and equipment or accounts receivable, where the point of them is to be a part of our revenue generating process. As a result, what else do we have? Operating asset turnover. So I'm referring to them as operating assets, but again, all these can be turnover. So that would say, which assets do I look at? I don't look at all my assets. I just go through and I figure out which ones are my operating assets. Just as a quick guide, you should expect that most of them are operating assets. So really what you're doing here is you're excluding the non-operating assets, your financial assets, the non-operating ones. So I would start with the stance of all of my assets are operations. I go through the balance sheet line by line, and I think, should I remove any of these? Because they're not, it's an asset that the company has, but it's not an operating asset. So the default position is leave all your assets in. You're just going to remove from that your non-operating assets. All right, fixed assets. This would look at just your fixed assets. And fixed assets we usually describe as assets that you have in place for greater than 1 year. You could also call these non-current assets. Things like property, plant, and equipment, but it also can include longer-term assets like intangible assets, brands, trademarks, et cetera, that you're going to expect to have for many years. So fixed assets is like the capital you've deployed in your business and you plan to keep there for a meaningful future. That's different than accounts receivable or inventory. So that would be a big portion of assets for some companies, particularly those that are capital intensive. And there we would say, look, it's like, what are the assets that we've kind of fixed in our business, meaning like really set there for years, and how does that category of assets do at generating revenue? So again, for all of these, the numerator is effectively revenue. The denominator is the average of the asset or asset category during the year. And each of them tells us, they tell slightly different stories, right? Total, operating, fixed, but each tells us some degree of how efficient they were at using, really it's using whatever's in the denominator. So using total assets, using operating assets, using fixed assets. For my last three, I want to kind of switch ever so slightly. And we'll elaborate on all of these when I do a deeper conversation on the cash conversion cycle, but turnovers of like my current assets or the ones that move more quickly. So just to be clear, we would absolutely expect that like inventory turnover would be higher than fixed assets. Inventory should be, I mean, my best example I can think of here, is like a grocery store or a restaurant. They have to turn inventory constantly, right? They're not going to be replacing that store every year. In fact, I'd be worried if they were. So their fixed assets should have, like, it'd be absolutely expected fixed asset turnover be much slower than inventory turnover. Inventory has to be constantly coming in, coming out, coming in, coming out. So for, a grocery store having an inventory turnover of greater than 12 times a year would make perfect sense. And there's no way a grocery store has a fixed asset turnover greater than 12 times a year. So the argument there is you're consistently moving things in and out of your inventory, right? So it should be kind of relatively high. Obviously, it depends on your business there as well. Inventory turnover, how quickly you turn over your inventory during the year, which is the average inventory on the bottom, revenue in the numerator. The number of times you want this to be higher. You certainly want this to be higher with some degree of perishability, my reason for using grocery stores. Accounts receivable turnover. This one, in the numerator, you can actually use cost of goods sold in the numerator for the inventory. And the argument there is that cost of goods sold is more of the cost of the inventory. So if you want to set aside a measurement of profitability, revenue includes the incremental amount you charge on your inventory. Cost of goods sold is actually what it costs you. So if you put cost of goods sold in the numerator, you just get a closer mapping of the efficiency. So it's not about profitability. How much money did you make? And revenue includes the amount of money you make when you sell inventory. That's why it may not be the best numerator for inventory. If you just look at cost of goods sold, then you can say, well, looking at the average amount of inventory I hold in my denominator and the actual direct amount it cost me during the year, cost of goods sold, that can tell me about efficiency independent of profitability. It's not a major mistake if you leave revenue in the numerator for all of these, but if your goal is to more closely look at profitability, the argument, I said that wrong, more closely look at efficiency and not profitability, you would want to make some adjustments and change your numerator here, particularly for one like inventory, it would be cost of goods sold. There's more of a deeper dive on all these in the Excel thing if you want more of the specifics, but the general idea is going to be the same. How do you take something on your balance sheet, use it well to generate revenue or another associated expense on like cost of goods sold in this case on your income statement? Accounts receivable, what do we do there? We leave revenue in the numerator here. What are we looking at in this case? How many times do we turn over our accounts receivable, which really means how quickly do we collect from our customers? So every time we have a sale, are we collecting in fewer days or more quickly? That's good in terms of efficiency of collections. Now, there's much more to running our business than just our accounts receivable, but this is getting at just the efficiency of collections. Inventory turnover is just the efficiency of selling products. It doesn't actually include everything else. And the reason we may want to break our turnovers into these specific line items, well, first, none of these line items on their own tell the full picture, but yeah, that may give us the specifics. How are we doing just at turning over inventory? How are we doing just at collecting cash from customers? That would be our AR turnover, our accounts receivable turnover. And finally, the last one is actually not an asset, accounts payable. It's going to be a liability, but the similar logic applies, so I wanted to include it here, which is that we can think about like how good are we at using liabilities without causing any major problems. So in some ways, that one, because it's a liability, an argument can be made when we don't want to pay too quickly, right? We also don't want to pay too long. It's not simply never pay our liabilities. We run into problems with our suppliers, but to the extent that we can push our payments a little bit in a way that doesn't cause any problems with our suppliers, we actually could argue that the last one, the efficiency, is actually slowing it down. So for a liability, in this case accounts payable, we actually want to slow it down a little bit. And again, I really want to be clear on this, not to an absurd degree, which causes bigger problems than the temporary cash we're going to save. But you have an opportunity to think about, well, if I can pay, let me give some numbers here. The turnovers talk about how many times during a year we pay something. But if you can pay slightly slower, that kind of might be freeing up cash temporarily in the business. Is that going to be changing your business or creating value? No, but it's just a degree of flexibility that you have of, hey, I don't have to borrow, go get a line of credit because I have a little bit of flexibility with my suppliers. With that, I want to conclude on these things before I get in liquidity. The goal of these is to be efficient, to use what you have, but use it wisely. It's not simply screw over your suppliers. It's not, sell out inventory. It's not always sell out inventory as fast as possible because your customers coming in the next day may want to buy something and they may start shopping elsewhere. So it's not always just maximizing these in isolation, but the general goal is the faster we move our assets, the faster we use, the more efficient we are using our assets to generate revenue, the better. And on the liability side, like the extent that we can reasonably slow things down, there might be some benefits. That's our efficiency stuff. I'm going to wrap it up. Take care.